Good afternoon. Welcome to our webinar on financial transactions. Today we will be discussing some recent developments in the field of transfer pricing and financial transactions. Our speakers today are Theo Elshoff, Managing Director of Quantera Global, Stefan Ubachs, Director, and myself, Senior Manager at Quantera Global. And together we are leading the financial transactions team within Quantera Global. Today we'll be discussing a few recent developments in this field. As already said, I think the agenda for today can be spread into 5 main topics. First of all, the introduction and recent developments. This is broader than just the OECD guidance and the Dutch transfer pricing decree. We'll also be discussing intercompany loans and some specific attention points. After that, we'll be discussing case law. That's also broader than the Netherlands. We notice a few important items in this respect. We'll also update you on these considerations. After that, Stefan will be discussing the Dutch transfer pricing decree and its impact on financial transactions. Obviously, we will also provide you with some key takeaways, and we will end with a Q&A. For your information, you can submit any questions in the section Q&A, and we'll discuss those questions at the end of this webinar. Theo, may I give you the floor?
Yeah, I'll start with some general comments, and they will maybe not be so surprising, but I think good to mention. And then I will go to financial transactions, some comments, and then the political landscape, and that will be a package. So I hope I will still be surprising you a little bit. I think the first, you see a nice photo on the right side. Somebody sitting in or driving in a swimming pool. And what's this message of this slide is that there's a climate change, and it's not only in the climate change what you see in nature, but also in the political and the tax landscape. And some general comments on that I think are now in place to do. The first one is, and that's obviously one that's important for us, transparency and the focus on substance is highly positive. That I would like to start with all the items that is happening on transparency. I think that's a good thing, because to discuss it with the facts on the table, I think that's always the right start. However, countries are in need of tax, and it's not a coincidence that the BEPS started in 2013 at the moment that we just had a recession. I think the same thing, and that's something that you hear around us. COVID is just around the corner still, but everything is changing around you. Countries are going to need some income for their budgets. So what's really coming along is that the countries will come to you for income for tax results. The other item is social pressure, and that's already a long time happening. I think people know still what happened around the inquiries in the UK and the US with Starbucks, Google, etc. And that perception is still growing, and that nice picture you see on the right side I got from newspapers in the Netherlands saying that not only multinational but also individuals with a lot of money and on the bank, and you see him in the swimming pool there, should also be burdened with more taxation, and that's perception, and that perception is driving a lot. What's driving it is, for instance, the TP guidance, but everything was around it. When I started in my career a long time ago, I read the white papers in the US, I read the guidelines in '95, and conceptually I could do something with it. I'm also an economic guy, so conceptually I read it, and I tried to also make it practical and for me and for my clients to get across. When I now read guidance, and I read the Dutch TP decree that was recently published, then I feel a little bit embarrassed and a little bit, they have to drive me to the paper to read it. because they're so political nowadays that you or have to read it 3 or 4 times what they really mean. So there's a lot of uncertainty in it and not changing things. That perception and that politics also will drive the tax authorities towards more aggressiveness. I just heard a head of tax of a big multinational saying, when I'm going to a country to defend myself on TP, the first thing I'm hearing is not an article or guidelines for the OECD, but more, you don't pay enough tax in this country, so your fair share is not okay, and that's difficult to defend. So that surroundings is something that you see also in court cases. I just discussed it with Adriaan, a court case recently. I know you're going into that topic in a slide, but you see that even judges in trying to support the tax authorities in cases are interpreting items they just can't interpret because they don't have the knowledge behind it. So when you do a documentation set and you think you are defended, then you could go into a strange discussion reaction with the judge because he's not really into that topic again. So that is something I also see happening. So it's more and more important that you are prepared, because you need to be prepared to be audit readiness to go into this area of almost a battlefield. And what we'll try as a last thing to get out of this slide is, for me, is that you need to have quality in the setting of your transfer pricing, in the implementation, but for almost all in showing and documentation. And all those court cases, there was some lack of that showing and documentation, your story, your defense into it. It was too much high level, and also the other documents was too high level, and that leaves the tax authority with the possibilities to use the perception and your fair share, and the judge to help him. I think that is something that's really happening at the moment, and you can make that far better as a defense for yourself, and it is necessary. Because if you go to the next slide, that's on financial transactions. I think the main message is there that you go into a new potential battlefield. Financial transaction is really a new area which are now popping up in all kinds of discussions with internally with clients, with tax authorities and audits that didn't pop up maybe 3 or 5 years ago. And there is something to it, because financial intercompany transactions is now far more on the radar of tax authorities. When I started my career and also with the tax authorities, I worked there between 2000 and 2007. Everyone was thinking how to use the arm's length principles of the transfer pricing guidance for financial transactions. Up till that moment, everybody was focused on EBIT. You know them, EBIT on cost, EBIT on sales, etc. But on the financial transactions, the item was more or less, can we say something about the interest rate? It just came from our ruling practice into OECD practice, interest rate. And for TP and discussions, you were more reliant on what was there on the tax law, on all kinds of limitation of deduction of interest rates. And that was at that time the way of looking into it, and guarantees and credit ratings, etc., which were things around the corner. And that has changed. I think BEPS triggered all those kinds of discussions, and also the tax authorities to go into that field and to try to understand how to drive the discussion with the arm's length principle and on interest. And what makes it even more complex is that if you look at the current situation, that is not only TP was driving the arm's length discussion on interest rates, but also who is benefiting from the interest income. And that could lead that you have all documented your TP as arm's length and still not have the full deductibility of it. So it is really a complex situation. Therefore, we started 5 years ago or 6 years ago with our financial team because we foresaw that this would be happening. Yeah, okay. And what I see with tax authorities that they still struggle with it. If you see that the knowledge of that is financial transactions and everything behind it is still rather limited. I have some examples. If you look at the current Dutch decree on which has a chapter on financial transactions, then you see that they are still struggling with how to cope with in control, who's getting the benefit of it. And there was even an example of 50 FTEs in the Treasury Department. And I think there's more behind it than this, but to me, I never saw a Treasury Department with 50 people. So I think they are struggling with how to use the word control and functionality and key functions and how to go into the area of what is still acceptable as a financial intermediary financial service activity. And there I see a lot of discussion still. We had just a discussion on the WACC, the weighted average cost of capital, and after an hour I understood that they didn't understand the difference between the pre-tax and the post-tax WACC. And then you think you have a discussion, but you need to get across what the other is meaning with WACC, as an example. Okay. Another thing is what you just read is the new guidance on the allocation of capital and debt to a PE. And there you see that they also are a little bit difficulty of allocation of those leverage to a PE, and that they mostly are going to choose for a simple solution that the PEs would have the same leverage as the legal entity, and that's obviously not I think always the right answer. So you see there's a lot of rather limited knowledge and potential discussions you could have with tax authorities in this kind of fields, and I think it is good to be aware of it. Another point that they can raise is that tax authorities are really struggling with what's an arm's length leverage of a company. What's really, because is there a range of leverage for a company? And you see that also the Dutch tax authorities then go to an investment grade or credit rating to say that's still acceptable for debt financing if you are within those ranges. But you can debate it for a long time if that's the right answer. So you see there's a lot of possible discussions there still. What else would like to say if you did combine those two? There's an international pressure on the handling of intermediary financial service entities. Because if you look at those, what I just mentioned, it is just in the end difficult to say what are we still accepting as a finance activity in a country which is then entitled to tax treaty benefits. Something that's not really happening if you look at the Dutch decree on it. And maybe on Stefan, maybe a question to him. What do you think about that part of the way it is going into the Netherlands, but international? What's still acceptable? You have on the other side, by the headquarters, the Treasury Center. You could have almost an entity with no substance, and the other side with intercompany loans into it and something in between. Yes. Can you maybe say something about that?
Yeah, indeed, Theo. What you clearly see as a development is that it is very important that you should be able to substantiate that what is being done by such an intermediary finance entity really adds value to the group. So it shouldn't be a mere routine support activity rendered by by a group entity with no or little substance. The tendency, not only in the Netherlands but worldwide, is that entities involved in financial transactions should be able to exercise control over the risks that are allocated to the entity, and they also should have sufficient financial capacity to bear the risks that are allocated to an entity. If not, you will only be able to receive a very small remuneration, only based on the costs of that specific entity. And even if the conclusion of the tax authorities is that the structure is mere setup for just for tax purposes and has no genuine use within the group, it could be ignored, and the transaction would therefore not be taken into consideration for tax purposes.
May say something about it as a reaction. I think that's a real good statement. It's a real good statement there. But you see that they're struggling with it. For instance, in the Netherlands, you see that the politics is driving towards. I want to be able to explain my my policy in the other countries when I go to Brussels or whatsoever. Yeah, I think there we are going in a way of sometimes even reality. On the other side, you see the tax authorities who have to deal with it in everyday life in cases, try to see what's still possible and what's acceptable, looking at business. And if you look at the Dutch degree, then you see that they put examples in that control with always 50 people in the Treasury Department. Just mentioned it. And there you see that they have made an example there that's not happening in I think in multinationals. Maybe there are, but there will not be many with 50 people in the Treasury Department. And then combine it with some risk and where the key people to control it. And it seems that they try to, with this text degree, help both to say the politics. We are going to look at the controls and business to see when we have enough people on the ground that do the controls, that they don't give a real guidance on what's still possible. You could even say in the Netherlands is Article 8C, which drives that more the intermediary financial entities. Is that still valid? Looking at this statements, yeah. Something for you to react, Stefan, on it?
Yes, yeah. You're absolutely correct, Theo. And as far as Article 8C is concerned, we will just have to wait and see how long the safe harbor thresholds included in paragraph 2 of Article 8C, the famous 1% and the famous amount of 2 million for the determination of an appropriate equity at risk level. How long that paragraph will continue to exist? As you may recollect, in November last year, the Haag Commission published its report and recommended, as first recommendation to the Ministry of Finance, to abolish the safe harbor rules of Article 8C. So we may not have seen the end of all the developments, and there may be some new developments in coming years.
We got the question about leverage of a PE, but I will get it on the end of it, because I think that would mean that we go into the question, but it's a good question that I get in for what's the leverage of a PE. Okay, if you then see that in combination of documentation requirements and also the growing MAP cases, as mutual agreement procedures around the globe, I think this is really an area where you have to be prepared and to look into your strategy on risk management sustainability, because this is something that will not get out of the radar of the tax authorities. And I think I expect in 2023 that looking at what then's coming to us on economic life and budgets for treasuries in the countries, that it will not go away and will even be worse. So I think it is a good time now to look into your strategic risk management of your financial transactions, and that you will talk to your treasury department as well, because I think both departments are there to get a reaction on what's happening. Yeah. Coming to my last slide of this introduction, I think changing political landscape. I think that the message of this slide is that predictability is an item, and that is in times of great uncertainties, I think even more complex for a tax department to handle. And you see on the left side some luggage and a plane, and it's not saying we have no difficulties to fly because there is a lot of problems at the airports, but the item is that multinationals are looking for certainty, for predictability with tax with countries and the end with tax authorities, and that is in some countries, and also the pity to say in the Netherlands, the predictability of what's happening. We had just a discussion on Article 8C on intermediary financial entities. Is that still possible, and to what extent? As an example of what's happening. Okay, we'll not go into what's there is, but I think that the most important item there is predictability. Today I read an article on the financial papers in the Netherlands that the Netherlands, and maybe we can go to the next slide, the Netherlands is still ranking 6th. We were 4th on the competitiveness ranking in 2022. But in that article also said there's so much happening on uncertainties at the moment that if you don't get a predictability and a strong leadership, that would lead to some problems in our ranking, and that could be that next year we are a little bit lower there. But I think that's also where you have to see more on strategic level what's happening and which countries am I in, and what's can I do by having that strategic risk management on financial transactions on a level that you can explain it to your CFO, but also to tax authorities. Okay, that's the part. I hope it was interesting for you, and I think that's the landscape we see at the moment. Yeah, and I'm glad that I can give it now to the key members of the financial team, and the first one will be.
Yeah, thank you, Theo. We've just discussed some developments. In this slide, we've also included some formal developments. As you can see, I think it really kicked off in 2018. In July 2018, the discussion draft on financial transactions was published by the OECD, and is formalized in 2020, and also included in the OECD Guidance in Chapter 10 in 2022. But as of 2018, that was the first time there was some guidance on financial transactions. Coincidentally, that's also the point in time where we see more increased interest from tax authorities on this topic, also in audits and in case law. But not only the OECD is providing guidance, also the Dutch decree on transfer pricing, which Stefan will discuss later on. There already was some wording included in previous degrees, but that's also something to consider when you're active in the Netherlands.
Yeah.
Additionally, something that's most people don't know about is the UN manual on transfer pricing. So there's a specific UN manual on the financial transactions part, which basically most of it is in line with the OECD guidance, but there's also some more guidance, for example, on credit rating and implicit support. So it's also worth reading or scanning through that document as well. In addition, we also have ATAT 123. So those are also 3 developments. with 8.3 being the most recent one, and the effective date most likely being in 2024, considering substance and avoiding shell companies and battling shell companies. Another item is the Deborah announcement. So the debt equity bias reduction allowance, which basically makes financing with equity more attractive, also compared to debt. So more going to introducing, for example, tax incentives for equity financing as well. Currently for debt financing, obviously you have the interest rate deduction, and they're also thinking about something to include for equity as well. As Theo also mentioned, so we see a lot of attention is shifting from the EBIT line, the P&L going down to the interest rate, and that's also what you can see here. There are a lot of even more developments than included in this slide, but yeah, that's just to show what is coming and what has been changed in recent years. Maybe one example, I think when the master file, local file requirements were initially introduced in 2015, and a lot of files were drafted, what we at that stage still saw were defense lines towards interest rates with, for example, bank offerings. And that's something that's drastically changed recent years, and something which is also explicitly excluded by the OECD. And something to consider as well. So defense lines that were used in the past should be re-evaluated, and that's something also to consider going forward. This is a slide I've used in previous webinars as well. I won't go into much detail today on this part. For more information on this part, I refer to our website in the section Quantera Global Academy, and then videos. You can see previous webinars on financial transactions as well. Basically, this is the 5-step approach towards determining at arm's length conditions for both the interest rate. But as you can see, the interest rate is only one part of the analysis, step 3 in this overview. You also have to think about control over risk, options realistically available, the conduct of the parties, what Theo also mentioned, the leverage, so debt equity, credit rating analysis, etc. One thing that is increasingly becoming important is step 4 and also step 5, prepare documentation. And that's also something I will discuss in a few slides regarding case law. What we see are some developments in this field where there was some documentation, but it was not good enough. So it's really important to not just have paper, but also have some storyline and background information on why you make certain choices. I think the monitoring process is also becoming increasingly important. What I can show you in the next slide, just a brief example, is increasing interest rates. So for example, the SOFR, the Secured Overnight Funding Rate, which is used as a reference rate in the US. And also the risk-free rate in the Netherlands are almost increased with 2% during this year. So you can imagine that if you, for example, perform an economic analysis based on data of 2021, you will get a different picture than when you use data of 2022. So there's also something to consider. Also, the COVID pandemic had also an impact on this, but monitoring is becoming increasingly important. And so also using an old benchmark study to substantiate new interest rates, that's something also that will probably not be defendable anymore. I think, Theo already mentioned it briefly in his introduction. What we see, and also something what frightens us a little bit, is recent case law, not only on financial transactions, but also on other types of transactions within transfer pricing. We see, however, a lot of cases are focused on financial transactions, and those cases are usually not as clear and straightforward as you would like it to be, and also not as consistent as you would like it to be. It's basically getting tax certainty for a taxpayer is with these case law which were recently published, it's getting a little bit of a gambling exercise. So you won't know what the outcome will be. Obviously, you will never know what the outcome will be, but sometimes it really deviates from practice and also common grounds which were set in the past.
We had a discussion about it, and there was one case there that the judge, the Court of Appeal said they put it back in the court of the tax authorities. You're not doing very well, so I can't give you now the adjustments. So, but I think these intercompany transactions you should also have been seen a regard into. Just go back and do your homework again, and then come to me again as a judge. Yeah? And that was really one item I thought was happening there, because the tax authority didn't have their act together. The judge see it, and they just gave him the possibility to try again.
Yeah.
The other one was, and things we had discussed it a couple of days ago, is that in the case the judge said that the comparability was not okay, and that the benchmark, there was more to it, but this was one of the items, that the benchmark only included companies with lower volumes than the group company, the total, and therefore couldn't be comparable. So he rejected from his own experience and view the whole set of benchmark economic analysis, and that was a little bit to me a little bit shocking, because then. How can a judge, I think 2 items, how can a judge say something about this item in isolation? That's one. And the other point is shocking. I think it is difficult to ask a judge to make an opinion in those kind of cases. So if you have really documentation there, defense, then the tax authorities have to discuss that with you, and not include a judge helping them. I think that's really a message here.
Maybe what's also important to note is maybe transfer pricing as a field of within tax is a niche. So transfer pricing is just one issue to cover for your taxes. A financial transaction is a niche within a niche, so that's an even further specialization within transfer pricing. What we also see here, for example, in Quantera Global, we started our financial transactions practice in 2017 or 18, if I remember correctly, 2017. By focusing on it on a daily basis, you develop knowledge and also create know-how in this field.
Yeah.
What I can imagine is that there are some that is currently not as structured for both tax authorities and also judges, because they have to cover way more than just this specific field. That also creates some information, lack, basically. So there's also something to consider, where something may be considered very common ground for practice. If you can't explain it well enough in your documentation, it may also be challenged by the tax authorities and even by judges, which follow the argumentation which were set during the process.
And to be honest, on the volumes, I never saw a comparability of economic search with comparables that were equal qua volumes and total consolidation income. When you look at the total groups where they were used as a comparability, and that to a judge to give that decision in such a case is a little bit what is that, shocking. Yeah. Okay.
Yeah, well, there's also a question. There is no perfect comparable, so you will never find it.
Yeah.
Just show that you that you find the best comparable transaction towards your knowledge. So that there are no specific reasoning behind it or cherry picking behind it. Just document the steps you have taken, and also document why you've taken some steps. Because finding the perfect comparables is never an option, and that's so difficult for judges to understand at this stage, but something maybe that should be developed throughout the years.
We had a discussion as well on it. Do the documentation to the best possible way. Have your story ready, your implementation, and your documentation. Then you will never get into this kind of mess, because that's what I see. That's a mess. Okay.
Okay. May we now proceed towards the Dutch transfer pricing degree, Stefan?
Yes, thank you. Thank you very much, Adriaan. Yes, a very important recent development for Dutch taxpayers is the recent publication of a new transfer pricing decree. The former decree dated back to April 2018, which was still before the release of the OECD discussion draft on financial transactions. And after the publication of Chapter 10 in 2020, it was of course important to get some new guidance in respect of financial transactions. Well, 2 weeks ago, the moment was there, and we all received the new transfer pricing decree, including guidance on financial transactions. And the Dutch Ministry of Finance first of all mentions that the Netherlands will in principle follow the OECD guidelines in this respect. So what is mentioned in Chapter 10 of the OECD transfer pricing guidelines is in principle it is very relevant for Dutch practice. But in certain cases, the OECD transfer pricing guidelines also leave some room for interpretation of certain elements, and the transfer pricing decree wants to give some guidance in that respect. As far as loan transactions are concerned, there are not many surprises in the new transfer pricing decree. The decree stipulates that there should be an accurate delineation of the financial transaction. So you should assess whether what is presented as a loan is also a loan for tax purposes. And in that respect, it is very important to apply what we always call the could have and would have approach. So in order to determine whether a loan, a prima facie loan, is also a loan for tax purposes, you should assess whether the borrower also would have been in the position to borrow that amount from a third party, and if so, so if he could have borrowed it, would he have borrowed it, or would he have financed the transaction otherwise, or even not entered into the loan at all? So please take into account that you should always examine the various options realistically available in assessing transfer pricing transactions, financial transactions. What is also mentioned in the new transfer pricing decree is new guidance in respect of cash pooling. And what is important to point out that the Dutch tax administration will pay attention to the question whether what is presented as a cash pool, as a cash pooling transaction, is in fact a genuine cash pooling transaction. Which means that a cash pool is usually for short-term funding. So there should be a certain volatility between the debit and credit positions of the participants in the cash pool. If not, so if there is a certain cash pool participant that has a long-term negative balance in the cash pool, that position may well be requalified by the tax administration into a loan, which would then obviously for transfer pricing purposes have to bear the arm's length remuneration for a loan, for a long-term loan, and that could of course have consequences for the interest rate to be taken into account. What is also mentioned in respect of cash pooling is that the group synergy benefits should be allocated amongst the participants after the cash pool leader has been remunerated. So that should also be taken into account. As far as financial guarantees are concerned, the guidance that is provided in the new decree is largely in line with the guidance provided in the 2018 decree. So not many surprises there. The Ministry of Finance recognizes that well, the yield approach can be applied in assessing the arm's length remuneration of an explicit guarantee. What is new is that in certain cases, when you are not able to provide a study to determine the arm's length level of a guarantee fee, the advantage of the guarantee can be split between the borrower and the guarantor of the loan. So it can be split 50-50 in certain cases. However, the real big news included in the transfer pricing decree is the guidance in respect of intermediary financial service entities. This guidance contains certain new elements that also derive from previous practice. So it's good to point that out. Well, first of all, for a financial service entity like any other transfer pricing transaction, you should have a look at the functions performed by the entity, the risks assumed, and the assets used. In respect of a financial service entity, the risk is of particular importance, and then you should have attention for two specific elements, and that is control over risk and the financial capacity. As far as control over risk, maybe we can have the next slide, please. As far as control over risk is concerned, you should have a look at who is doing what and who is able to exercise influence and take a decision on whether you are going to take the risk. So are you going to enter into a loan? And are you able to manage that risk? So during a loan, are you able to take decisions that are important in respect of that loan? Are you going to take steps towards a borrower that is not paying? So that is important. Also, do you have sufficient financial capacity in respect of the risks assumed? Now, what is meant with financial capacity? Financial capacity means that the entity, so the financial service entity, should have access to the funds that are necessary to take on the risk or to lay off the risk. And also the entity should be able to bear the negative consequences once the risk materializes. So that is very important, and what the Ministry of Finance does in the decree, as Theo already mentioned, they basically describe two positions that are completely opposite. So as you can see on the next slide, the first situation that is described is the situation in which a financial service entity has full control over risks. That is the situation in which the people that are employed at the level of the financial service entity themselves have full control and are therefore able to decide whether to take on a loan, negotiate with banks, able to assess the risks, to manage the risks, etc., and also have the full capacity to bear the risks. And that is a situation certainly in respect of intermediary financial service entities that you will not encounter frequently in practice. That is something that you will normally see at the level of a treasury center, at a head office. So it is not something you will see at the level of the standard financial service entity that is dealing with incoming loans and subsequently on loans that sever that same loan under more or less the same conditions. The other on the other side of the spectrum, the decree describes an intermediary financial entity that does not have any control over risk. So it means an entity that only carries out routine support activities in respect of the incoming and outgoing loans. So just, well, let's say administrative activities and some day-to-day management activities that do not include any key decision-making aspects in terms of controlling a credit risk, controlling debtor risk or market risk. So that is something you would expect with an intermediary financing entity that does not have any substance or just has some directors that merely carry out what they are instructed to do without any specific knowledge on treasury activities. And then we come into the gray area. That is everything that happens between those two. The decree describes the situation in which there is shared control over risks. But in the example given in the decree, the tax administration points out a situation in which there are employees employed at the level of the financial service entity in the Netherlands, and also there are employees employed in another country, but all those employees, so the employees that work in the Netherlands and the employees that work abroad, all have control over risks in respect of certain loan transactions. And in that case, according to the decree, you can split the remuneration between those groups. But what is not expected, according to the decree, is that there is a contractual limitation of risk, which always used to be something that's frequently used in practice. Again, following the safe harbors of Article 8C. So what you typically encountered in practice is that the risk assumed by the intermediary financial service entity was limited to either 1% of the loan amount or 2 million euros, and the remainder of the risk was borne by the head office or the parent entity or any other entity within the group. So, and whether what is still possible in that respect remains open for discussion, or remains to be seen. As Theo explained, well, those two extreme cases. So if you have full control, you're entitled to the full remuneration, and if you have no control at all, you are not entitled to that remuneration, but just a mere remuneration based at cost plus a markup. That's clear. But what happens in that gray area? That is something that we also should see in practice. What will still be acceptable? But the message, I think that is very clear, that it is important to assess whether any financial service and entities within your group that are carrying out activities in the Netherlands, to what extent they really add value to the financial activities performed, and do the employees really carry out genuine activities? Are they able to exercise control over risk? Does the entity have financial capacity? And also, what is the percentage of activities that consist of on-lending amounts that can because a financial service entity is described in the decree as an entity that predominantly carries out intermediary financing activities, and predominantly in Dutch for Dutch tax purposes means at least 70%. So it may also be good to assess what other activities are still carried out, to see whether you would still be you would still qualify. So maybe back to you, Adriaan.
Thank you, Stefan. I think, briefly summary, and then we go to the Q&A. We've got a few questions.
Yeah.
There are a lot of developments in this field, a lot of things you have to consider. There's growing attention from tax authorities on this field, a lot of audits, also specifically on this part. There's a lot of room for discussion and disputes, so be prepared and prepare documentation that not only fulfills the check the box items, but also includes a nice storyline why you come to a certain conclusion. And also mentioned it's important to have a process in place to monitor these transactions and also the risks involved. I think maybe Theo, you have anything to add on that part, or shall we continue with the Q&A?
I think that's the most important thing, the last one, that you look into what's happening at the moment and see where you are in situations, and act on this in a strategic way, and look into it as in totality. So the whole treasury function and how the finance function within a company, and then see what are the risks, what are the opportunities, and am I all that ready? That's, I think, what I would like to say here again, because that's important.
Okay.
We got some Q&As in.
Yeah, sure. Maybe this is a good question for you, Theo. Someone asked, what is meant by leverage of a PE?
Thank you for that interesting question. A long time ago already, there was some authorized OECD approach here, which said that a PE should be treated for transfer pricing in a similar way, equally to a legal entity. That gives some concerns, because always risks are with the legal entity, and how to allocate that to a PE, because the legal entity already had it as a per definition. One of the answers to the OECD approach was that also for a PE, you have to create a balance sheet and a P&L, profit and loss, similar to what a legal entity would do. And in that allocation on the balance sheet, there is a question: what is the equity part and the debt part of the PE? Because it also then immediately goes into the P&L, that part and debt, and the interest to be allocated on it. And that leverage, that's meant with the balance sheet, and that in the end it will affect the P&L. And there you see that tax authorities have a couple of methods to do so. They had 4, and this decree there was just 2 mentioned, and the one that is preferred is that you look at the balance sheet of the legal entity, and that you, in a similar way, you would allocate the debt and equity, that PE. And I think that's really a little bit shortcut there to what it should be. But for time's sake, I think if you would like to understand more of it, then please, I will give you a reaction on it, because I know who has asked it, and I see the name there. Thank you for that. Okay, then I have a question for you. What got in is what's the specific topics you see under scrutiny by tax authorities currently? Very busy, but what are the main topics?
Yeah, we see quite a lot. So good question. I think there are some Vrouws Legis part work, which may be more obvious. So the total structure is set up to avoid taxes. You see a lot of cases on that respect. Also, obviously, cases on the interest rate, but also how an interest rate was determined. And then one of the main items is the credit rating, for example. Do you have a standalone credit rating, a group rating, and implicit support? What do you use? And how do you assess the implicit support part? So there's a lot of discussion on that topic. What Stefan also mentioned, for cash pooling, it's mainly the qualification part. So is it a long-term loan transaction, or can it actually be qualified as a cash pooling transaction? If there's no fluctuation, then maybe it can be regarded as a loan transaction, a long-term loan transaction, also with another interest rate, obviously. Also guarantees is a very important aspect. That's something maybe that's not that's a little bit more difficult than the usual analysis, but that's also getting increasingly attention. And one of the main parts which I forgot regarding loan transactions, you also have the debt equity part. So how much debt can you actually bear in a company? I think that those are the main items.
We got more questions, but I find that one that's now coming in nice. How will partly in control intermediary be remunerated going forward? Will the privileged accepted approach HC on the 1% and 2 million as at risk? Will it still be valid? I think that's to debate. certainly that in control and substance will grow on you on in this question. But therefore, I said in the beginning that this tax decree has examples which are a little bit besides what's happening with 50 people in the Treasury Department and then explaining control in that perspective, 50 people. I don't know how they come up with 50, but that, I said on the politics side, they will certainly try to do something about this kind of guidance, something that will come. But if you look at the tax degree, you see that tax authorities try to give examples that give them some possibility to still accept this, I think. But that's the way I read it, because this example is so fictitious that you can't say, well, why is it so fictitious? Because 50 people is a little bit too much. But the answer will be, we think it is still acceptable, but there's no guarantee on it. That's something I still have to say. And maybe
one final question, and then because we're it's
okay,
one past.
Maybe to you, can you? There's one question. Can you apply a safe harbor interest rate, such as Australia and the US? Do we have a safe harbor there?
Oh, that's a good question. Yeah, I'm personally not a big fan of safe harbors, because there are always two parts of the transaction, two countries involved. And then basically you may have one happy country, but the other country may get don't get sufficient taxable profits here. So my brief answer would be no. I don't think safe harbor approach is a right approach to use for financial transactions. Obviously. Yeah.
The last comment, there was one question, but it's very quick. Someone would what should I do as it? Looking at what's happened was cascading of developments. I think let's step back, look at what you're in, what your current situation is, current structure, current documentation, policies, and then have a brainstorming on it, and to see with the Treasury Department and someone that is in this all, see where you are, and then make a decisive decision on what to do on it. And because that's something I think is happening, because it's so complex at the moment that's really, don't rush into it, but get a step back and look into what you should do. And it will be complex, and it will be challenging. That will be for certain happening around the corner. Okay.
Okay, maybe thank you all for your time, and we will share the email, and the recording will also be posted on our website.
And somebody gave that to me a long time ago, and okay, thank you for listening to us. It's not easy, but take it easy. Okay.